An investment portfolio consists of individual stocks, bonds, and other assets that collectively represent the total investment assets of an individual or entity. Diversification, which is the process of purchasing a variety of securities, is essential to successful investing. Mutual funds are investments that pool individual investors' money. An advantage of mutual funds is they offer individual investors the opportunity to diversify even with limited funds. The risk associated with the economic environment in general, and which diversification actually cannot eliminate, is systematic risk. Risk that can be greatly reduced through diversification is unsystematic risk. The combination of systematic and unsystematic risk is your total risk. Passively managed mutual funds, which are also known as index funds, are set to mirror the returns in the stock market rather than beat them. A market index is an unmanaged grouping of stocks that has been identified as representative of some aspect of the economy or the stock or bond market. Actively managed mutual funds are set to mimic almost any type of individual stock, bond, or other investment in the marketplace. They seek to bring a higher return than the stock market. Value-oriented investors look for underpriced stocks or bargains, but growth-oriented investors seek stocks where the share price is quickly increasing. Here are some tips to keep fees on mutual funds to a minimum. Avoid sales-loaded mutual funds. A sales load is a one-time commission paid to an investment salesperson either when the mutual fund is purchased or sold, so you should look for no-load mutual funds. No-load mutual funds do not charge a sales load, which saves the investor money. Another tip is to avoid paying 12b-1 fees if possible. A 12b-1 fee is an annual fund marketing expense that is passed on to shareholders in the mutual fund. These range from 0% to 0.2%, and they average around 0.13%. Another tip is to buy the mutual fund with the lowest expense ratio. A mutual fund's expense ratio is a measure of the total management fees and expenses charged to the mutual fund on an annual basis and includes the 12b-1 fees. The ratio expresses the percentage of the mutual fund assets that are used to pay these recurring expenses. Expense ratios range from less than 0.1% to more than 2.5%. The lower the expenses, the higher your returns. So keep in mind that the majority of mutual funds sold today charge a load. All of them charge an annual management fee. Asset allocation funds invest in several mutual funds based on a predetermined ratio of stocks and bonds. As such, they can be designed to better match an individual investor's risk tolerance. Target date mutual funds are a special type of asset allocation fund managed based on an individual's expected year of retirement. Unlike other mutual funds, the asset allocation in the fund changes over time and becomes less dependent on stocks and other risky assets as the target retirement date approaches. These are actually also used for college savings, with the target being the time that the student will begin college. The rate and pattern at which the asset allocation shifts from more to less risky in a target date fund is referred to as that fund's glide path. The goal is to reduce return volatility as an investor grows older.